Welcome back to Boni's Life, where we decode the markets so you don't have to lose your mind or your portfolio. Today, we are diving deep into the current state of the cryptocurrency market. Whether you are a short-term scalper, a mid-term swing trader, or a long-term diamond-handed investor, this episode is your ultimate survival guide. We are going to analyze exactly what type of market we are trading in right now, break down the technicals across multiple time frames, and give you actionable strategies to navigate the chaos. And trust me, with everything happening globally, from the Federal Reserve's latest shockers to escalating geopolitical tensions, you need a solid plan. So, grab your coffee, hit that like button, and let's get into it. First things first, we need to identify exactly what type of market we are currently trading in. If you look at the data as of late March 2026, the answer is unequivocally clear. We are in an extreme fear, range-bound consolidation market. The crypto fear and greed index is currently sitting at a dismal 10 out of 100. We have been stuck in this extreme fear zone for over 65 consecutive days, which is one of the longest stretches of sustained bearish sentiment we have seen in recent history. The total cryptocurrency market capitalization is hovering around $2.47 trillion, down slightly, with a 24-hour trading volume of about $96 billion. Bitcoin dominance remains exceptionally high at 58.35%, which is a classic sign that capital is fleeing from riskier altcoins into the relative safety of the market leader. When we look at the derivatives data from CoinGlass, the picture becomes even more interesting and slightly concerning. Open interest across the board is sitting at roughly $104.5 billion. However, the recent recovery attempts have been characterized by very low leverage participation. The long/short ratio is almost perfectly balanced at 50.37% to 49.63%. Funding rates are virtually flat, with Binance BTC/USDT sitting at a mere 0.0049%. What does this tell us? It tells us that traders are exhausted. The speculative froth has been wiped out by recent liquidation events, including a brutal $163 million flush in a single hour just days ago, and a massive $88.7 million single Bitcoin liquidation. This is a market lacking conviction, waiting for a catalyst to pick a definitive direction. Let's break down the technical analysis, starting with the king, Bitcoin. Currently trading just under $70,000, Bitcoin is trapped between two massive technical levels. On the downside, we have the ultimate line in the sand, the $68,000 support level. This isn't just a random round number. On-chain data shows this is the average cost basis for whales holding between 100 and 1,000 BTC. It also perfectly aligns with the 200-day moving average at $67,800. If this level breaks, the volume profile shows a massive void down to $65,000 and potentially $62,500. On the upside, immediate resistance sits at $71,000, with the major boss level resistance at $74,450. The RSI on the daily chart is hovering around 47, dead neutral. The MACD is showing indecision, with moving averages flattening out. We are coiling up like a spring, and the longer we coil, the more explosive the eventual breakout or breakdown would be. Ethereum is facing its own technical hurdles. Trading around $2,133, it recently broke below a critical 0.236 Fibonacci retracement level at $2,091, which is now acting as overhead resistance. The next major resistance for ETH is up at $2,312 and then $2,718. The altcoin market as a whole is bleeding against Bitcoin, as evidenced by the altcoin season index sitting at a neutral 53 but trending downwards. Until Bitcoin makes a decisive move and establishes a new trend, altcoins will likely continue to chop around and underperform. We are seeing a flight to quality within the crypto ecosystem itself. Now, we cannot trade in a vacuum. Technicals only tell half the story. Fundamentals and global events are the catalysts that break these technical ranges. And right now, the macro environment is an absolute minefield. First, we have the Federal Reserve. At their March 17th to 18th FOMC meeting, they held rates steady at 3.50% to 3.75%, which was entirely expected by the market. But the shocker was their revised inflation forecast, bumping 2026 PCE inflation up to 2.7% from 2.4%. 7 out of 19 Fed members now project 0 rate cuts for the entirety of 2026. The market probability for a rate cut has been pushed all the way out to July. This higher for longer reality is acting like a wet blanket on risk assets, including crypto. In fact, Bitcoin has now dropped after 8 of the last 9 FOMC meetings, a clear sell the news structural pattern that traders need to be aware of. Adding fuel to the fire are the geopolitical tensions, specifically the escalating situation between the US and Iran. While President Trump recently paused strikes on Iranian energy infrastructure, citing productive conversations and hinting at a deal within 5 days, the uncertainty has already done its damage. Brent crude oil surged 60% over the past month, crossing the $100 mark. This energy shock is exactly what is complicating the Fed's inflation math. When geopolitical fear spikes, we see a flight to safety. Gold futures are up, the US dollar index is strengthening at 99.17, and Bitcoin, despite its digital gold narrative, is trading more like a high beta tech stock, selling off as institutional players de-risk their portfolios. And if that wasn't enough, we have a massive crypto-specific event looming on the horizon. The FTX Recovery Trust is scheduled to begin distributing $2.2 billion to creditors starting March 31st through April 3rd. While some of this capital will undoubtedly be reinvested into the market, the initial reaction is often fear of immense sell pressure. We are already seeing Bitcoin ETF flows become erratic, with a recent $130 million net outflow snapping a 7-day inflow streak, though we did see a slight recovery of 2,460 BTC inflows just yesterday. The market is jittery, and every headline is being traded aggressively. So, how do we actually trade this mess? Let's break it down by time frame, starting with the short-term traders, the scalpers, and day traders. In a range-bound, low-conviction market, your best friend is volatility at the extremes of the range. You should not be trading the middle of this $68,000 to $74,000 chop. Your strategy is mean reversion. Look for quick, low-leverage scalps when price deviates into the $68,000 support zone. Watch the order book and CoinGlass liquidation heat maps. When you see a flush of late shorts getting trapped near $67,800, that is your trigger for a quick long scalp back to the $70,000 mid-range. Conversely, if we pump to $71,000 or $74,000 on low volume, look for rejection wicks to short back down. Keep your stops tight, because if $68,000 breaks, the drop to $65,000 will be violent. For the mid-term traders, the swing traders looking for moves over days or weeks, patience is your strategy right now. You are waiting for confirmation, not anticipation. The trigger for a mid-term long position is a daily candle close above the $74,450 resistance, accompanied by a spike in spot volume and a positive shift in the MACD. If that happens, your target is the $78,000 to $80,000 region. However, if we see a daily close below the 200-day moving average at $67,800, that is your trigger to enter a swing short, or at least hedge your spot portfolio, targeting the $62,500 deep support level. Do not front-run the breakout, let the market show its hand first. Finally, for the long-term investors, the ones looking months or years ahead, your strategy is dollar cost averaging, DCA, but with a tactical twist. We are currently 44% below the all-time high of $126,198 set in October 2025. The Fear and Greed Index is at 10. Historically, buying when the market is in extreme fear yields the best long-term returns. However, given the macro headwinds of sticky inflation and delayed rate cuts, you shouldn't deploy all your capital at once. Set limit orders at key structural supports, $68,000, $65,000, and $62,500. If the FTX distribution or a macro shock pushes us down there, you automatically accumulate at whale cost basis levels. Ignore the day-to-day noise. Focus on the fact that exchange balances are dropping, meaning supply is shrinking, and let the institutional adoption cycle play out over the next 18 to 24 months. Let's dive a little deeper into the fundamental analysis for those who really want to understand the mechanics of this market. The total market capitalization is a crucial metric. At $2.47 trillion, we are seeing a significant contraction from the highs. This isn't just retail money leaving, this is institutional capital rebalancing. The volume profile is also telling a story. With 24-hour volume at $96 billion, it sounds like a lot. But in the context of a $2.47 trillion market, it's relatively thin. This thin volume is what makes the market so susceptible to sudden violent swings based on news headlines. When volume is low, it takes less capital to move the price, which is why we are seeing these erratic wicks on the charts. The fear and greed index is perhaps the most psychological indicator we have. At a reading of 10, we are in the depths of despair. But remember the old adage, be greedy when others are fearful. This doesn't mean blindly buying every dip, but it does mean that the risk to reward ratio is starting to skew in favor of the bulls for long-term horizons. The fact that we have been in this extreme fear zone for over 2 months suggests that the weak hands have largely been shaken out. The people selling now are either forced liquidations or those capitulating out of sheer exhaustion. Open interest is another critical piece of the puzzle. At $104.5 billion, there is still a significant amount of leverage in the system. However, the fact that the long/short ratio is so balanced means that there isn't a clear consensus among derivatives traders. They are hedging their bets. When open interest is high but the market is range-bound, it's like a powder keg waiting for a spark. A sudden move in either direction will trigger a cascade of liquidations, which will only accelerate the price movement. This is why I emphasize tight stop losses for short-term traders. You do not want to be on the wrong side of a liquidation cascade. Let's talk about the global events again because they are the true wildcards. The Federal Reserve's stance is the biggest headwind. The market had priced in multiple rate cuts for 2026, and the Fed has essentially pulled the rug out from under those expectations. The revised inflation forecast of 2.7% is a clear signal that the fight against inflation is far from over. This means that the cost of capital will remain high, which is inherently bearish for risk assets like cryptocurrencies. Until we see a definitive pivot from the Fed, or at least a softening of their hawkish rhetoric, it's hard to envision a sustained parabolic bull run. The geopolitical situation with Iran is equally concerning. The Middle East is a powder keg, and any escalation could send oil prices soaring even higher. This would exacerbate the inflation problem, forcing the Fed to remain hawkish for even longer. It's a vicious cycle. Furthermore, the uncertainty surrounding the upcoming US elections and the potential for new tariffs under a Trump administration adds another layer of complexity. Tariffs are inherently inflationary, which again plays into the higher for longer narrative. And then there's the FTX distribution. $2.2 billion is a massive amount of capital to be injected back into the ecosystem. The fear is that creditors who have been locked out of their funds for years will immediately sell their crypto assets for fiat to cover living expenses or simply to exit the market. This could create a significant supply shock, especially in a low-volume environment. However, there is also the possibility that a portion of this capital will be reinvested into the market, particularly by institutional creditors who still believe in the long-term thesis of crypto. The reality is likely somewhere in the middle, but the anticipation of this event is undoubtedly contributing to the current market anxiety. So, to summarize the strategy for navigating this complex landscape, for the short-term scalper, focus on the extremes of the $68,000 to $74,000 range. Trade the mean reversion, watch the liquidation heat maps and order book depth. Keep your leverage low and your stops tight. Do not get chopped up in the middle of the range. For the midterm swing trader, patience is paramount. Wait for a decisive daily close above $74,450 or below $67,800 before committing capital. Look for confirmation from volume and momentum indicators like the MACD. Do not try to predict the breakout. React to it. For the long-term investor, embrace the fear. Use this period of consolidation to accumulate at key structural support levels. Set your limit orders at $68,000, $65,000, and $62,500. Focus on the macro trend of declining exchange balances and increasing institutional adoption. Ignore the short-term noise and stick to your DCA strategy. This market is not for the faint of heart. It requires discipline, emotional control, and a deep understanding of both technical and fundamental analysis. But for those who can navigate the chop and position themselves correctly, the rewards will be substantial when the next bull cycle inevitably begins. Remember, the market is a mechanism for transferring wealth from the impatient to the patient. Be patient, be strategic, and always manage your risk. That is the Boni's life way. If you found this deep dive valuable, please smash that like button, subscribe to the channel, and hit the notification bell so you never miss an update. Leave a comment below with your thoughts on the market. Are you buying the fear or are you waiting for lower prices? I read every single comment. Until next time, stay sharp, stay disciplined, and happy trading.